Okay, so welcome to week 5. We are now 25% of the way through our course. And I just want to share a couple things real quickly. I did forget to upload apparently, or there was some problem with uploading the lab. So I did finally do that over the weekend when it was brought to my attention. So for this semester, this is spring 2023. I went ahead and extended the due date on the chapter 4 exercise set and problem set by a day, well, until Monday evening to give extra time. So hopefully you were able to get that in. If there are any issues, let me know. But I do apologize. Feel free, if you ever notice that I don't upload the lab within a couple hours after the live session, then feel free to bring that to my attention so I could fix it. I also wanted to point out that there was quite a bit of activity in the video number 1 discussion, so I did get that graded. Good job to everybody for participating, actively and thoroughly in that. I also did grade the personal journal activity for those who decided to participate in that extra credit activity. So that's pretty much it as far as my updates. And let's go ahead and get started here on chapter 5. Okay, so in this chapter, we are completing the accounting cycle. We have learned about the first 7 steps of the accounting cycle in the last 2 chapters. We learned about identifying and analyzing transactions, posting them to the journal, posting them then to the ledger, making our unadjusted trial balance. Those are the first 4 steps. Then we learned about making adjustments, right? Last week, and then the adjusted trial balance, and then making the financial statements. So those are the first 7 steps of the accounting cycle. In this week, we're going to look at steps 8 and 9, which are the last 2 required steps. And here we learn how to close out some of the accounts. And the reason we do that is some of the accounts are temporary. They only last for a year. So you close them out and then you start over with the next year. After you close out those accounts, you make your post-closing trial balance. That is step 9. So that's what we'll be doing today. All right, there's a 4-step process that we're going to learn for that. But before we get into that, we're going to start with what is the difference between a temporary and a permanent account? As it says here in exercise 1, a temporary account can also be referred to as a nominal account, but I just use the term temporary because I think it's more clear. And a permanent account can be called a real account, kind of like real estate. But again, I use the term permanent. Now, the accounts that get closed out at the end of the year, or sometimes a shorter period, but the accounts that get closed out are the temporary accounts. The ones that don't get closed out are the permanent accounts. And it's pretty easy to remember which are which. Temporary accounts are revenue, expenses, and dividends. There's also a new account we're going to learn about called income summary. That's also temporary. But that's it. Revenue, expenses, dividends, I forgot, and income summary. There can be some others, but those are the only ones we're going to see in this chapter. All other accounts we're going to see in this chapter are permanent. You could think of those as the balance sheet accounts. So asset accounts are permanent. Liability accounts are permanent. Stockholders' equity, like common stock, preferred stock, those are permanent. Retained earnings is a permanent account. Okay, so all those accounts that show up on the balance sheet are permanent. So with that in mind, the first exercise here asks us to distinguish between temporary or permanent. The first one is accounts receivable. Well, that is a balance sheet account because it's an asset. And so that's a permanent account, and I'll just identify that with the letter P. Fees earned revenue. Revenue accounts are not part of the balance sheet. They're on the income statement, right? And they do get closed out. So they are temporary. I will indicate that with a T for temporary. Utility expense. Expense accounts are also temporary and show up on the income statement. Prepaid rent is an asset, so like accounts receivable, that is also permanent. Okay, so those are the answers for exercise 1. It's really windy and there's a door that keeps slamming. I don't know if you can hear that, but I apologize if you can. So going on to number 2, basically the same thing, temporary or permanent. And does this account show up on the balance sheet or income statement? Well, if it's permanent, it's going to be a balance sheet account. If it's temporary, it's going to be an income statement account. So interest expense is temporary and it's an income statement account. Buildings are assets. Those are permanent, meaning that the account does not get closed out at the end of the year. We would only close out a building account if we sold the building, right? Otherwise, it's permanently on our books. So it's going to keep showing up on the balance sheet. Interest payable is a liability, so that's on the balance sheet and it is permanent. Unearned rent revenue. Remember that word unearned means that it's not really revenue. So even though the word revenue is there, this is a liability account. We haven't earned it. So that would also be on the balance sheet and it would be a permanent account. So for number 2, the first is temporary and income statement. The other 3 are permanent and balance sheet. Okay, let me know if you have any questions. Otherwise, let's look at number 3. Here, it's asking the same question, but in a different way. Would the account be closed at year end? So if it's temporary, then yes, it would be closed. If it's permanent, then no, it wouldn't. And then we also have to identify the financial statement that it shows up on, balance sheet, income statement, or also retained earnings statement. So accounts payable, that would not get closed out because it's permanent and it's a balance sheet account. Same thing with accounts receivable, same thing with cash. All of those show up on the balance sheet. So they do not get closed out. Dividends, on the other hand, do get closed out. They are one of the types of temporary accounts that get closed out. And the reason for that is so that you can know how much in dividends you declared this year, and then you start next year from 0. Just like with revenues, you'd want to close it out, so you start the next year from 0. And same thing with expenses. So you can know what were the expenses every year, what were the revenues, what were the dividends. So dividends, yes, they would get closed out, and they show up on the retained earnings statement. E is fees earned revenue. So yes, that gets closed out. That shows up on the income statement. F, insurance expense, also gets closed out. Shows up on the income statement. G, prepaid insurance. That is an asset. So that's going to be no balance sheet. And H is supplies. That's also an asset, so no balance sheet. Okay. So A, B, C, G, and H are all balance sheet accounts that do not get closed out. D does get closed out, shows up on retained earnings statement. Revenues and expenses also get closed out. They show up on the income statement. All right. Moving on to number 4. Okay, here is that 4-step closing process I told you about. So this is not too hard. So let me go ahead and we're going to practice it multiple times, but the first time I'm going to go through it a little bit slowly and explain exactly what we're doing. So imagine it's the end of the year. We need to close out our temporary accounts. First, we're going to close out our revenue accounts. Then we'll close out our expense accounts. To do that, we use a new account called income summary, but that's also a temporary account. So we're then going to close out the income summary account. That's step 3. The fourth step is we're going to close out dividends, which is another temporary account. Okay, so step 1, revenue. Step 2, expenses. Step 3, close out income summary. Step 4, dividends. All of those accounts will have a 0 balance at that point, and then we can do our post-closing trial balance. Now, in this example, we're given the data here. There's only one revenue account. Now, sometimes companies have multiple types of revenue. This company has only one. So for the entire year, they had $85,000 of revenue. Now, if you think about, does revenue normally have a debit balance or credit balance? Well, it's not part of deal, right? Because deal is dividends, expenses, assets, and losses. And revenue is not any of those. So it increases on the credit side and normally has a credit balance. So to close out that $85,000 credit balance, we need an $85,000 debit to that account. Okay, so service revenue has an $85,000 credit balance. We're going to debit it the same amount so that the balance will now be 0. Okay, sorry, there's something on my keyboard irritating me. Okay, so I hope that makes sense. Now, if we debit something, we have to credit something else. And this is where the income summary account comes in. Since we're debiting service revenue to close it out, we're going to credit income summary. Okay, and then we're done with step 1. Step 2, we need to close out our expense accounts. Now, expense accounts are part of deal, so they normally have a debit balance, and to credit them out, we would need to, or to close them out, we would need to credit them, right? So they have, let's see, advertising has a $5,600 balance. So we're going to credit $5,600 to advertising to close it out. Then we have rent, salaries, and service. Oh no, oh, that service is a revenue. We have rent and salaries. We're going to credit those out, and then utilities expense. Okay, so we're crediting all 4 of the expense accounts the exact amount of their debit balances so that they will now have a 0 balance. So then we are going to debit something, right? So we're going to debit income summary. And to get the amount, all we do is we add up the 4 credits. Okay, so if I did that right, I'm pretty sure I did, it's $67,100 that we are debiting to income summary. Okay, so in step 2, you're always going to credit your expense accounts and debit the total to income summary. Let me know if any questions come up. Otherwise, we will move on to step 3. Now, step 3 is the one that can be a little bit confusing. In this case, it's pretty simple. We see here that we credited income summary $85,000 in step 1. We then debited income summary $67,100 in step 2. So if we were to go to the income summary account, we would see 1 credit for $85,000, 1 debit for $67,100, and the balance would be the difference between the 2, right? So we could take the $85,000 credit minus the debit, So the balance in income summary is $17,900. And because the credit side is bigger, it's a credit balance, right? We see this credit here is bigger than this debit. So when we find the difference, when we subtract, we still have a credit balance. So that 17,900 we now need to debit to close out the income summary account. Okay, so we take the difference between these two and then we credit it out. Another way to think of it, we have an $85,000 credit to income summary. And if we add up these two debits, 67,100 plus 17,900, we see we have $85,000 in debits to income summary, right? So it washes out and we now have a zero balance in income summary. But if we're debiting income summary, we have to credit something. We're crediting retained earnings. And this makes sense because if you think about it, the income statement is revenue, right, minus expenses. And the difference is net income. So if we went to our income statement, we would see revenue of 85,000 minus expenses of 67,100 is net income of 17,900. So that's profit, which increases our retained earnings. And that's what we're doing here, right? Because retained earnings is not part of deal. It increases on the credit side. So that's how you can think of this all. Where step 3 could be a little bit confusing, what if your expenses were more than your revenues? Then you're going to have to credit the income summary account and debit retained earnings. And that makes sense too, because if your expenses are more than your revenues, you're losing money and your retained earnings is going to go down. So it would make sense that it would get a debit, okay? As we practice it, it'll make a little more sense. That door keeps slamming over there, driving me crazy. But that's step 3, okay? So sometimes you have to reverse the order. When that happens, when the expenses are greater than the revenues, what you do is you switch the order of these two accounts. You would then debit retained earnings and you would credit income summary in step 3. Okay? Moving on to the 4th step, anytime you have dividends, your 4th step is you're just going to take the amount of the dividends. Always it's going to be a debit to retained earnings and a credit to dividends. So the only exception there would be if you didn't have any dividends issued throughout the year, then you just skip step 4. Okay. So that is our 3-step closing process. All right, are there any questions? Okay, let's move on to step 5 then. Or question 5, exercise 5, sorry. It's been a long day. First day back after the holiday. By the way, I hope you all had a good holiday weekend. And I'm still on vacation in my brain. Okay. Well, here we have the numbers already of the 4-step closing process. We just need to input the account names. So we know the first step is you close out your revenues, and we can see that fees earned revenue is the $90,000, right? So let's think. Revenue normally has a credit balance, so we would close it out by debiting. So it's going to be a debit to fees earned revenue. And then we credit income summary. The second step is going to be a debit to income summary, and we're going to credit our expense accounts. So we can see the expense accounts here. I'm just going to copy and paste, but remember you have to indent whatever account you're crediting. Okay. So that's our step 2. We debited income summary, credited our expense accounts. Step 3, here's where we close out the income summary account. So we can see income summary had more credits than debits, right? So we're going to have to debit income summary to close it out. If you subtract, you take the $90,000 credit minus the $63,300 debit, you get a difference of $26,700. So that's how much we'll need to debit to get it down to 0. And the credit goes to retained earnings. Again, because we made a profit here with higher revenues than our expenses, that increases our retained earnings. And the final step, this is our $6,000 worth of dividends. Always it's going to be a debit to retained earnings and a credit to dividends. There we go. That is our exercise 5. Any questions there? Okay, let's go on to number 6. This one mixes it up a little bit. We're going to have to fill in some numbers and some account names. Okay. Okay, so sales revenue. This account or this company has only one revenue account. It's 194,000. Notice it has a credit balance, so we have to debit it to get it down to 0. And so we credit income summary the same amount. Oops, too many zeros. Then step 2, we always debit income summary and we credit our expense accounts. So we have automobile, then we have insurance, salaries, and supplies. Okay, we have more revenues than we had expenses. So we're going to have to debit income summary for the difference. The difference comes out to $46,000. Credit goes to retained earnings. And the final step, we debit retained earnings and credit dividends. All right. We're already up to exercise 7. So 7, it's the same 4-step process, but they've given us the data in a different format. We see that cash has a debit balance. We don't actually need cash, right? Because we're dealing with temporary accounts and cash is a permanent account. So ignore cash. Revenue, we're going to have to close out. We've got 3 different expense accounts we'll have to close out. Dividends we'll have to close out. And retained earnings, we're not going to need the beginning retained earnings balance, so they're just trying to throw us off here. What is our first step? Our first step, close out revenue, right? It's got a $220,000 balance. So on the credit side, so we're going to need to debit and credit income summary. Step 2, we debit income summary and credit the expense accounts, right? So let's look at the expense accounts. Advertising is $12,000. Rent is $18,000 and salaries is $120,000. If we add those up, we get $150,000. Oops. So that's the total we debit to income summary. Now again, our revenues are greater than our expenses by $70,000. So we're going to need to debit income summary to close it out. And what do we credit? Retained earnings. Okay. Last step, we debit retained earnings and credit dividends for the amount of the dividends. Number 8 is going to be similar. Let's see, what was our revenue account? We had 43,000. That's our only revenue account. Close it out with the debit. Credit to income summary. Then our expenses. We have commission expense, so that would be commissions we paid to our sales employees. Supplies expense and wages. Okay. We can add those together. We get 37,200, I believe. So now take our revenues minus our expenses. So we see that our income summary account would have a $5,800 credit balance still, since the credits here were on the debits. So we have to debit income summary. Once again, what do we credit? Retained earnings. And then our final step, close out the dividends by debiting retained earnings, crediting dividends. And that makes sense because dividends are part of deal. They normally have a debit balance, so we would close it out with the credit. And retained earnings are not part of deal. They would normally have a credit balance. And since dividends decrease retained earnings, it makes sense that we're debiting retained earnings by the amount of the dividends. Okay, it all makes sense. And if there are no questions, we go on to exercise 9. So again, once we have closed out our temporary accounts, then step 9 of our accounting cycle is we do our post-closing trial balance. So here it's asking which of these accounts would be listed in the post-closing trial balance. This is another way of saying which of these accounts are permanent accounts, because if they're permanent, they would not get closed out and they would show up on the trial balance. If they're temporary, they would have been closed out to 0 and we would not include them because they have a 0 balance. Okay, so the permanent accounts are the ones where we're going to say yes, they would be listed on the post-closing trial balance. Accounts payable is a permanent account. It's on the balance sheet, so yes. Advertising expense, no, that is temporary. Remember, expenses are temporary. Dividends, also temporary, so that's a no. Fees earned revenue, temporary, that's a no. Prepaid advertising is an asset, so that is permanent. That would be a yes. Supplies are also an asset. Supplies expense are an expense, so they are temporary, and that would be a no. And unearned fee revenue, although it has the word revenue in there, it hasn't been earned. So it's a liability, so it's on the balance sheet, so it's permanent. So the answer is no. Yes, the answer is yes. Sorry, got myself confused there. It's permanent, so the answer is yes. They would be listed on the post-closing trial balance. Okay, so let's double check these answers because my brain's a little foggy now, as is usual by this time on a Tuesday. A, E, F, and H are yes. Okay, exercise 9 is right here. A is yes. E and F are yes, and H is yes. Everything else, B, C, D, and G were all no. Okay, so we got it right. Okay, despite my fuzzy brain and the door slamming over and over and over, it's like every 30 seconds, it's slamming. Okay, moving on to exercise 10. Which of the following accounts would not be listed on the post-closing trial balance? So in other words, which of these are temporary accounts that would be closed out and would not be on the post-closing trial balance? Well, prepaid insurance is permanent, so it does not get closed out, and it would be listed on the post-closing trial balance. Same thing with land, that is another asset. Notes payable is a liability, retained earnings is an equity account that is on the balance sheet. However, insurance expense would be closed out, so it will not be on the post-closing trial balance. What else? Service revenue, same thing. It would also be closed out and would not be on the post-closing trial balance. Supplies are an asset, so they will be on the post-closing trial balance, but salaries expense is another expense, so that is our third account that will not be on the post-closing trial balance. So the answer is insurance expense, service revenue, salaries expense. All right, moving on to 11. In which section of the classified balance sheet would each of these be presented? Okay, now in the chapter 5, it talks about the classification. Sometimes on a balance sheet, the assets are classified into different categories so that anybody looking at the balance sheet knows not only what's the total amount of assets and what are the assets, but also can see the total amount per category. The categories include current assets, which are, as you probably remember, those are assets that either are already cash, or they could be converted to cash within a year, or they are likely to be used up within a year. Or an operating cycle, which could be a little more or less than a year, depending on how long it takes the company to spend money on products or services, provide them to customers, and then get paid by those customers. That is one operating cycle. So sometimes companies use that to determine what's current, or sometimes they'll use a year. In this class, we usually just go by a year. Okay, so a long way of saying that current assets are those that are going to be used up or could be turned into cash within a year. Then we have our non-current assets. Those would include property, plant, and equipment. That is land, buildings, vehicles, equipment. That's pretty much it. We have intangible long-term assets. Intangible assets would be patents, trademarks, copyrights, and something called goodwill. We have long-term investments. We could also have short-term investments. Those would be current assets. If we have an investment that we plan to cash out within a year, that would be a current investment. But typically companies hold their investments for more than a year, so those would be long-term investments. What else could we have for assets? That's pretty much it, just other long-term assets. And same for liabilities. You can have current liabilities that you are planning to pay off within a year, and then long-term liabilities that will take more than a year to pay off. Okay, so that's the classification of assets and liabilities. In the textbook and in the PowerPoint, there is a very useful graphic. I'll go ahead and show it to you. It is, let's see, I'll have to find it here. It is in wrong textbook, sorry. That is part 2 of our textbook, or volume 2. We are in volume 1. Okay, chapter 5. And where is it here? think it's towards the beginning. And okay, not in the first section. It's also in the PowerPoint. So if I don't find it here, I'll pull it up there. But this is a useful graphic to use when you're trying to figure out if an asset is current or if it's long-term, and if it's long-term, which, yeah, it's not there. I don't think it's here. I don't know why the system's so slow right now. So I'm just going to open it up in the PowerPoint. It is in the textbook, I am sure, but since it's going kind of slow and I'm not finding it, we'll just do it this way. Okay, it is. Okay, why am I not seeing it here? Was it last week? There it is, there it is, there it is, okay. Figure 5.11. Okay, so this could be useful if while you're working on the problem set, you're trying to figure out the classification of an asset. You can ask yourself, is it cash or an asset that will convert to cash or be used up or sold within a year or one operating cycle? If the answer is yes, it's a current asset. I know that's a long sentence, okay, but just read through it. If the answer is yes, it's current. If the answer is no, then is it a tangible asset, something that could be touched, that's being used to help generate revenue? That would be property, plant, which is a factory, and equipment. And property includes land. So if it's property, plant, or equipment, then yes. If it's not one of those, then you go down here to no. Is it a stock, bond, or other long-term investment that you're going to hold for more than a year? If yes, it's a long-term investment. If no, it must be an intangible asset. Okay, so that might be a helpful flow chart. Again, it's in the textbook somewhere. Yeah, anyways, it's somewhere in there. Figure 5.11. Okay. So let's see, going back to here. For exercise 11, that's what we need to do here. So accounts payable, we know, is a liability, and our suppliers expect us to pay them typically within a month or two. So this would be a current liability. Accounts receivable is an asset, and we expect to be paid by our customers within a month or two, if not sooner. So that would be a current asset. Cash is a current asset. Equipment is property, plant, and equipment, right? So you could either put PPE here or property, either way. E, land, is also PPE or property. F, a note payable due in 2 years. So that's a liability, but it's also long-term because it's not due until after this year. So I'll put a long-term liability. You could also call it a non-current liability. Same thing. Just two different ways to call it. G, prepaid insurance. That is an asset, and we don't pay for insurance for more than a year at a time typically, so it's a current asset because we'll use it up within a year. And same thing with supplies, those will get used up within a year, so they are current assets. Okay, so we have current liabilities for A. B, C, G, and H are current assets. B, C, G, and H are current assets. D and E were property, and F is long-term liabilities. All right. Moving up right along here to number 12. Okay, here we get to a new concept, nice and easy one though. You're gonna like how easy this is. We have two ways to look at liquidity, and liquidity means how easy is it for the company to pay off its short-term debts. The more short-term or current assets you have and the less short-term or current debts you have, the more liquid you are. And why is it called liquid? Well, think of it, if you own a building, you can't really spend the value of that building. You'd have to sell it, and that might take months or even years, right? So you can't really touch the assets that are tied up in that building, in the value of the building. So it's kind of frozen. But cash or inventory or other things that you can turn into cash pretty quickly is liquid because you can spend it soon. Okay, so long-term assets, think of them as frozen, short-term assets are liquid. So liquidity for a company is how well it can use its short-term assets to pay off its short-term debts. And that's what we use, current assets and current liabilities. Now, there are two basic ways to look at liquidity. One is we could take our current assets, subtract our current liabilities, and the difference is what's called working capital. We see that right here. Current assets minus current liabilities equals working capital. And that really means how much money or capital do we have available in the short term to work with? Because if it's tied up in some long-term assets, we can't really work with it. And if we need to use the available short-term money to pay off short-term debts, well, we can't really work with that either. So it's how much extra short-term assets do we have compared to our short-term debts. So we take current assets minus current liabilities, and that gives us working capital. So for this company, it's $28,000 in 2018. And then in 2019, their current assets went up. Their current liabilities went up as well. And the difference, again, is their working capital. Okay, so you just take current assets minus current liabilities, gives you your working capital. So we see for this company, their working capital increased significantly from 2018 to 2019. That's one way to measure liquidity. Another way is what's called the current ratio. This uses the same numbers. It uses current assets and current liabilities. The only difference is you divide. So we take $76,000 in current assets divided by 48,000 in current liabilities. And in this case, we get 1.58. Generally, you want to round off to 2 places after the decimal point. So what this means is our current assets are 1.58 times as much as our current liabilities. And then we do the same thing for 2019. We take current assets divided by current liabilities. Here we get 1.8 or 1.80. Okay, so that shows improvement. The current ratio went up. That means the ratio of assets compared to liabilities increased. Our current assets went up faster than our current liabilities. And that's a good thing. That means we've got more money available to work with. Okay, so that's pretty easy. If you don't have any questions here, let's move on to a couple other exercises working related to liquidity. In this case, we've got the numbers. We need to fill in the account names or category names. So we see in 2018, this company has $8,700 of what? Well, if we add up, there are three types of current assets here: accounts receivable, cash, and prepaid advertising. That's where this 8,700 is coming from. So we know that is current assets. And if we add up 2019, we'd get this 31,050. So those are the current assets for 2019. Everything else, accounts payable, utilities payable, and wages payable, those are the liabilities. If we add up 2019, you guessed it, we get the 4,625. We add up 2019, we get this number. Okay. Then if we subtract the current liabilities from the current assets, again, we call that working capital. You can probably guess what's coming next. You see we have the same current assets and current liabilities down here. In this case, though, they're being divided. And when we divide, we call that the current ratio. So in this case, it went from 1.88 down to 1.46. That's not great. It's good from a dollar perspective that their working capital went up, but the ratio went down. So it's good from a dollar perspective in this particular instance. Bad when we compare the ratio of current assets to liabilities. That's going the wrong direction. So if they continue on that trend, eventually that could create a problem. Okay, and then moving on to number 14 and 15. We'll be done with the exercise set at that point. Then we'll move on and do 4 problems. And I think we'll be done early today. Okay, so on this one, here we're, instead of comparing 2 different years, we're looking at 2 different companies. So again, we've got current assets and current liabilities here. The difference is the working capital, right? And in part B, we've got our current assets and current liabilities. We divide to get the current ratio. So for company J, 1.12. For company K, 1.17. Okay. Which company has the stronger liquidity position? Well, there are 2 ways for us to look at it. One is to look at the working capital and compare that. Another way is to look at the current ratio. So if we look at the working capital of the 2 companies, we see company K has more. That's good for company K, right? If we look at the current ratio, company K came out better there as well. So company K is stronger in terms of liquidity. Why? Their working capital and current ratio are both higher. Okay, so this is good for investors or other analysts that are trying to see how liquid the company is, how well it can pay off its short-term debts. Because if a company is not liquid, if they've got high short-term liabilities and low short-term assets, they might run into issues where they don't have money to pay their bills, they can't pay their employees, they don't have money to grow or buy materials, right? So that's why you always want to have a good working capital and a good current ratio. Okay, and our last exercise, number 15. Here they're just giving us a little bit of a twist. All right, let's just do it like that for now. So what are the current assets? Well, cash, accounts receivable, and prepaid insurance. Those are current assets. Let's add those up. And that's 51,300. What are the current liabilities? Well, that would be the accounts payable and salaries payable, right? Because common stock is equity. Service revenue increases equity. Expenses decrease equity. So the only liabilities here are accounts payable and salaries payable. 31,100. Oops. Okay, then we can subtract to get the working capital, 20,200. We can divide current assets by liabilities to get the current ratio. Okay, so let's check that. Should be 20,200. Which one is this? Number 15. 20,200. Yeah, we got that right. Very good. We're done with the exercise set, and it's not even 5 yet. All right, so let's go to the problem set and do 4 problems. And we will be done. This is problem set chapter 5. Okay, we're going to start with number 3. Okay, back to our 4-step closing process. Step 1, we close out our revenues. This company had only one type of revenue. So we debit fees earned revenue. We credit income summary. Then we close out our expenses. We do that by debiting income summary and closing out the expense accounts, which are these 3. Remember, we have to indent the accounts that we're crediting. Okay. Then step 3, Step 3, remember I said sometimes it could be a little tricky? In this case, check it out, our revenues were less than our expenses. So when we look at the balance of our income summary account, we have more on the debit side. So if we take the 95,640 debit to income summary, we credit the 89,200 credit, or we subtract, the 89,200 credit to income summary. The difference is we still have 6,440 on the debit side in the income summary account. If you don't believe me, just do a T account. Put this credit on the right, put this debit on the left, find the balance, and you'll find that you still have 6,440 on the debit side. So you're going to have to credit income summary. And what do we debit? We debit retained earnings. Okay. If this does not make sense, another way to think of it is when your expenses are more than your revenues, you need to debit retained earnings because you lost money and your retained earnings is going down, and you need to credit the income summary account. And then our final step is always debit to retained earnings, credit to dividends, unless, of course, we didn't have any dividends. Okay, so that's number 3. Next is number 9. 9 is right there. Okay. So this is our adjusted trial balance. Okay, so adjustments have been made. Then after we close out the temporary accounts, what would be the post-closing trial balance? Okay, so part of this we know. Cash does not get closed out because it's an asset. Same thing with prepaid insurance. Same thing with fixed, which are long-term assets. None of those would have gotten closed out. So those stay the same on the post-closing trial balance. Our liabilities would not have gotten closed out. I said getting. It would not have gotten closed out. Common stock would not have been closed out. Retained earnings is also not closed out, but this retained earnings is our beginning retained earnings. And remember how the net income changes the retained earnings, which then changes what goes on the balance sheet. Okay. So this is our beginning retained earnings, but we're going to have to figure out the ending retained earnings. Now, the rest of this is temporary accounts. Down here, we've got our dividends, revenue, and expenses. They're all nicely kept on the bottom of the trial balance. Okay, so what we have to figure out then is what is the ending retained earnings? Now, the easy way we could cheat here is we could take our cash, add it to our prepaid insurance and our fixed assets. So in other words, add up all of our debits. And in this example, that came out to 70,900, right? We know that our debits must equal our credits. So we could, if we wanted to cheat here, subtract the other two credits and figure out retained earnings must be the difference, 5,900. Okay, but again, that's kind of cheating because sometimes it might not be that easy. You might not have all of that information. So, and anyways, even if we do it that way, let's double check by calculating our ending retained earnings and see if it really comes out to 5,900. So one way we could do that, I would say the logical way, is we take our beginning retained earnings, okay? That's how much we had earned in the past that carried over. We didn't pay it out as dividends, so it's still with us at the beginning of the period. We could add to that our revenue from our sales. Then subtract from that our expenses, because those decrease revenue, and our dividends, which actually decrease retained earnings, is what I should have said, right? Both the expenses and dividends decrease our retained earnings. So let's take out the dividends. Let's take out all of the expenses. And let's see if I did it right. Perfect. Our ending retained earnings came out to 5,900. So what we did, we took our beginning retained earnings plus our revenues, subtracted all of our expenses, and we got $5,900. So that would be our ending retained earnings. And that makes sense. We started with a much higher retained earnings, but this company had a lot of expenses and they paid out $22,000 in dividends, which was probably not a smart idea if they weren't making a lot of money. So they didn't quite have enough revenue to cover all of that. So that decreased their retained earnings, right? The loss from having low revenue compared to the expenses decreases retained earnings. The dividends decrease retained earnings further. And everything adds up down here. So hopefully that makes sense. That was problem number 9. We're now going to do 10 and 12. Okay, let me just double check make sure I'm remembering correctly. Okay, yes, 10 and 12. Got quite a few problems to work on your own this week. Okay, problem 10, prepare a corrected post-closing trial balance. So here we have a post-closing trial balance, but there are two mistakes. We know that there are mistakes because the debits do not equal the credits, right? So something's wrong. So let's take a look. In fact, the account names are fine. We can go ahead and put the account names in. Let's take a look. So cash normally has a debit balance. Prepaid insurance normally has a debit balance, right? And so does fixed assets. All of those are assets that they would normally have a debit balance. That's one of the problems. Up here, there was a credit to fixed assets. How could that be? How could you have negative fixed assets? That doesn't really make sense, right? So that was one mistake. That's supposed to be a debit. Okay, notes payable, that's a liability, so that's supposed to be a credit. Common stock, that's normally a credit as well, right? It's an equity type of account, but it's not part of deals, so it's normally credit. So that was the other mistake. And then retained earnings also normally has a credit balance. So that was correct. If we add these up, let's see what we get. On the debit side, I get 85,400. On the credit side, oops, I forgot to, I don't know what I did. Let's try that again. Hi, Jane. Okay, it came out that time, 85,400. Welcome, Jane. We are near the end, actually. We have just one problem left, but you'll be able to view the recording. And if there are any questions, we can stick around and I'll be glad to answer any questions for you. But there we go. So that is number 10 solved. And our final problem we will do together is number 12. Okay, so it looks like we are making a classified balance sheet. Okay, so here's our adjusted trial balance. So yes, this would be the step. Once we've made our adjustments and our adjusted trial balance, that's when we can make our financial statements. Again, we've got our assets, and we have our liabilities, and we have our equity accounts. Okay, so we're going to start here with the balance sheet, filling in the assets. If they are in the right order, it looks like they are. Oh, that's right. It's a classified balance sheet, so we're going to do the short-term or current assets separately from the long-term or non-current assets. Okay, so we've broken down our assets into two different classes in this case. Sometimes you might have more, but in this case, we just have current and non-current. So this total here, 38,000, this is the total of our current assets. Oops. Okay, so those, you see that there's a section here for current assets. So we listed them, and then we have total current assets. Now, sometimes in the next section, you would put non-current assets or some other title. In this case, since there was only one, they just left it by itself instead of giving it a title. So if we take our total assets of 38,000 plus our 14,000 of equipment, we get total assets of 52,000. So formatting wise, sometimes you'll see a third column being added. Sometimes, again, you'll see it broken down to non-current assets, and then it'll say equipment, and then total non-current assets. So there's some flexibility on the formatting. You basically just want to format the way that's going to make the most sense for whoever's going to be looking at the financial statements. And in most cases here, the formatting is provided for you, so you just fill it in. Okay, then we're going to go on to the liabilities section of the balance sheet. We have only two liabilities. They are accounts payable and unearned fee revenue. So what do you think we call the total? Total liabilities. Then we go down to stockholders' equity. So we have common stock is 30,000. And what is this 3,500? If we look up here, we don't see 3,500 anywhere. We also don't see retained earnings. So this company had 0 beginning retained earnings, but they then had some earnings during the period. How much did they earn? Well, they had revenue of 21,500 minus their expenses. So this is something we would see on the income statement, right? Revenue minus expenses equals net income. You could also see this in your closing entries. We close out the revenue of 21,500, close out the expenses of 18,000. The difference of 3,500, which is our net income, also would need to get closed out to income summary, but it increases our retained earnings. And that's what we're doing here. There were 0 retained earnings at the beginning for this company. We're increasing it by the difference between the revenue and the expenses. And so our ending retained earnings, which we simply just call retained earnings, is 3,500. The reason we don't have to put ending is because it's as of this day, which is the end of the year. So we know it's ending retained earnings. Okay, so again, that's the tricky part here. Normally how we would do this is we would do that 4-step closing process. Then we would prepare the post-closing trial balance, which would already have that ending retained earnings on it. In this case, we didn't do that. We're working with the adjusted trial balance. So we had to figure out what the ending retained earnings would be. Okay, and that means that this number of 33,500 is our total stockholders' equity, right? Because this section was stockholders' equity, and this is total stockholders' equity. So our final label down here is total liabilities and stockholders' equity. Okay, so we have total assets here. We have total liabilities, total stockholders' equity. Add those together, we get total liabilities plus stockholders' equity, which equals total assets. So that means we are in balance and we are done with the problem set, or at least for the lab. And it's only 511. All right, are there any questions? No? Well, I'm going to stop recording then. All right, so where do I do that? Here we go, stop recording.